All right, everybody, welcome to the latest episode of the Sherman Show. We are recording this today on March 15th, 2022. And I am here with my co-host, Sam Lau.
Hey.
And today we have a very unique guest. Her name is Ellen Carr. She's a high yield portfolio manager and principal at Barksdale Investment Management. Welcome to the show, Ellen.
Thank you for having me.
Well, thank you for joining us. And, a lot of people maybe aren't familiar with you or Barksdale, but it's a majority woman-owned boutique institutional investment management firm. You're out of Nashville. I think we saw that you reside in Asheville as well, too, where we visited one of our colleagues to have a wedding there one day. But in addition to your job as a PM, you're an adjunct professor of finance at Columbia. And you teach courses on credit, not shockingly being a high yield person, but more importantly, you're also a writer. And, we stumbled across your work, not just on your contributions, what we see out there in the financial media, but also you co-authored a book about women in investment management. And the title of that book is Undiversified, the Big Gender Short in Investment Management. And we just thought that this was a great topic to really talk about. We're always talking about, diversity, inclusion. It seems to be very topical. And so maybe you can start up on how, look at even Sam. Sam's even putting up a copy of the book. So talk, Sam, so the Zoom picks you up.
Hello, check out the book.
Okay. Yeah, I don't know how the Zoom camera works, so we have to make sure we get that right. But can you tell us what was the genesis of this collaboration with Katrina Dudley on the book on Undiversified?
Yeah, well, again, thanks for having me. And I think because it is germane to the book, I should point out that our introduction came through a female portfolio manager at DoubleLine, Monica Erickson. So there are women who do what we do. So the genesis of the book on my side primarily came from my experience as an adjunct at Columbia. I've been teaching there for almost a decade now. And I noticed that even though Columbia's student body is creeping towards parity from a gender perspective, the people who took my class were much more male skewed. The headline number that we cite in the book is that only 10% of portfolio managers are female. And what I found is that coincidentally, only about 10% of the students in my classes, which tend to be pretty investing oriented, since that's what I do, it's literally the only thing I'm capable of teaching to anyone. Only about 10% of the students in my class were female. And several of the adjuncts and I made this observation year after year and sort of scratched our heads and said, why is that? This is a great career. From a work-life balance perspective, it's actually not as challenging as some of the other careers that women choose in droves. So look at investment banking, for example. Better diversity metrics. I have yet to meet an investment banker who doesn't work more hours in their early years than I'm actually awake. So much better balance in, the sort of hierarchy of finance jobs, and a really great career for a lot of different reasons. So I reconnected with Katrina right after I had coincidentally met a Columbia Press representative who said that he was looking for books from the adjunct faculty. And we started talking about a book, and one thing led to another. And we decided to write a book together. And thank God we did, because Katrina is the yin to my yang. She says yang because she's Australian. But we absolutely complemented each other very well. We are good at different things. I'm one of those people that if I can say it in 3 pages rather than a sentence, I will. Katrina's a great editor. She kept me on task. And I'd like to think that I breathed a little poetry into the book at times. So it was a collaboration and a labor of love that really came from the experience that we both had of being, in the classroom in my case, and then in both of our cases, the one woman in a sea of Patagonia Brovest at whatever conference we were attending.
The Patagonia Brovest.
It's a thing.
Yeah, it is a thing. It's the bane of our attire. You can see here, we like our DoubleLine polos, but yeah, we just don't understand the vest being out here on the West Coast. I guess it's because we're not situated in San Francisco. But, it's very interesting. You talk about that too, about just this kind of 10% is in the industry. You notice that parallel in the classroom. So maybe you can tell us about how you got started in the business. How did you, get into investment management? what drove you to see these things, and how do you try to impart that on some of your students at Columbia?
This is one of the themes of the book, Jeff. So I knew very little about investment management when I graduated from Kellogg a gajillion years ago. I'm way older than I look, by the way, and decided to pursue this career path. So I went to business school with a consulting background, and I was a career changer. And the only thing I knew for sure, and this is going to sound awful, but I will say it, is that I wanted a lucrative career. And so I spent my summer on the sell side at Morgan Stanley doing a sales trading research rotation, decided that the sell side was not for me for a lot of reasons, but really got hooked on the research component. What I worked on there in my summer was a lot of fun. So I ended up pivoting to the buy side for my full-time job. I thought, this may be super quantitative and it may be something where I'm stuck behind an Excel spreadsheet, but I'm going to give it a try. Happily, I went to work for one of your neighbors, Capital Group. And Capital is a place where you're really encouraged to be creative and unique and differentiated in your thinking. It takes a very long-term approach to investing. I ended up in high yield because that was, to me, the perfect blend of equities and fixed income. You get to think about both sides. And I spent, the ensuing, 12 or so years there, really building my own framework for credit research and then transitioning from an analyst to a portfolio manager, which is a pretty typical transition and something we talk about in the book as being a stumbling block for women in particular, for reasons we might talk about later. What I have always loved about the career is that it is intellectually demanding. It is not a career full of numbers. So there are quantitative approaches to investing that, for example, highly quantitative funds like Dimensional or quant shops would use, but that is by no means the only way to generate alpha. And in my almost 25 years in the business, I've learned that there are probably a lot more ways not to generate alpha than to generate alpha. However, many of the approaches that the best investors use, whether on the credit side or on the equity side, are very fundamentally, narrative, analytical. I like to say that the most important lessons that I learned as an investor were actually not at business school, but in getting a degree in literature as an undergraduate, because that's where I learned to analyze texts. And when I read the 10K of a company, that's the approach that I take. So I'm looking at the text that management has provided for investors. I get really nervous when I see poetry. I like to see prose. You keep an eye on the company over long periods of time to make sure that they're actually doing what they say they're going to do. And by the way, and y'all know this because you are in fact fixed income investors, we don't have the levers that shareholders have, right? So once the ink has dried on the bond indenture that we just purchased, after exactly 15 minutes of research, our leverage is gone, no pun intended. So as a result, you really have to be sharp on getting that background on a company and making sure that management is doing, especially with respect to the balance sheet, what management said it was going to do.
Yeah, no, it's interesting you say that too, because I think your pun was intended given all your prose and your background in literature. I find that very fascinating as well, because we talk to a lot of investors out there that, they can be quantitative. So that's kind of a lot of stuff we do. I think there's a lot of psychological elements too, where you're trying to see the psychology of markets and things. But I don't think I've ever really stumbled on someone who actually thought there's beauty in the literature of the indenture. And so I find that very interesting, but it makes sense too, because when you're trying to cover something up, right, or you're trying to make that flowery language, it's probably not as substantive as it can be. But, when you talk about this introduction of, let's say, women into the financial roles, you said there's a stumbling block. You mentioned that too. Why do you think that stumbling block exists, and how do you advise people to try to help overcome that?
So in the book, we break down the solutions into basically three components. So early stage of the pipeline. And here we talk about the undergraduates and the MBAs, and then the investment management firms themselves and what they can do for women as they go through that pipeline. And then at the end of the book, we actually issue a call to arms for everybody who is part of the financial infrastructure And we call that everyone who's got a 401k or an IRA. And we challenge them to, ask the question, who manages my money? But if you start at the very entry level of the pipeline and even go back further than undergraduates, we know that parents, based on a study, parents talk to sons and daughters in the same family differently about money. So parents are more likely to talk to daughters about things like saving and budgeting. Parents are more likely to talk to their sons, on the other hand, about investing and taking risk. So some of these attitudes that investing is the purview of men can happen at very young ages. As you go through then and get to the undergrad level, we found, based on a study that we partnered with a Rutgers professor to do of undergraduates in the United States, that there are lots of blocks from the perspective of perception. So our industry has an image problem. Many young women, many young people, but in particular young women, think of investing based on what they see in the popular media. So this might be movies like The Big Short, where I'm sure you've never seen it, but in case you haven't, there's lots of really awful scenes, including one where they're basically doing research in a strip club. So I can tell you, I've never done research in a strip club, not part of the job. Then if you look at movies like The Wolf of Wall Street, which by the way is about the sell side, but because there's so little exposure to the career path of investment management, a lot of young women don't know the difference between, that's those sort of boiler room type movies and what they would actually be doing if they went to work in investment management. And they don't get exposure to women who do the job, or really anyone who does the job. So then when you get to the MBA level, it's a different set of issues. So women who matriculate into MBA programs often consider investment management as a career path. But because of the cadence of the recruiting cycle, they may feel like they're behind, even if they start looking at these jobs, the first day that they set foot on Columbia's campus as a first year. The reason for that is because unlike jobs like doctor, where you're expected to complete your degree and then do your job, in investment management, lots of the big firms, I don't know if DoubleLine is like this, require their hires to do a pitch. So usually this is a stock pitch. Usually students spend, based on a study we did, about 60 hours developing the stock pitch in their first year. That might be without any background in finance because they're doing their coursework at the same time. And as a result, a lot of women lack the confidence to put themselves forward for those plum investment management jobs. And so they may decide, the investment banking job is a sure thing. There's a gajillion investment banking jobs. I know that I'll do well in this interview process. I don't have to do a stock pitch. It's the safer route. So that can be a real impediment to women going into the industry. And then finally, sorry.
No, go ahead. Give me the finally. Yeah.
Well, the finally is once you get into the realm of investment management firms and looking at why women sometimes don't stay once they've started there, we talk about equalizing the 3 Ps. So here we're talking about pay, performance evaluation, and promotion cadence. And we found a whole lot of off-the-shelf third-party research that says that there are ways to address these issues. But first, as a firm, you have to understand your data. So we're great at data, right? That's what we do. We look at companies. We know everything about the companies in our portfolios. We know everything about the way that our portfolios are laid out. But sometimes we're like the cobbler's children with no shoes when it comes to analyzing ourselves and looking at our own data for these issues of pay equity, promotional equity, and then performance evaluation.
Yeah, you mentioned that too. Sometimes our own personal trading accounts are highly neglected. That the whole cobbler's children has no shoes. But you use the phrase like in describing it's like barriers to advancement, and I think that's essentially what you're describing here. Is that there's just these challenges within a lot of the firms within the industry. But you also use another phrase that Sam really liked that was called widening the on-ramp. Explain that phrase and what you mean by that and how you think that can help facilitate some of this transition.
So we talk about widening the on-ramp at the undergrad and at the MBA level. So at the undergrad level, there are lots of great organizations. Well, lots is a strong word, but there are several organizations that are working very hard to help undergraduates, young female undergraduates, understand the career options that are available to them, and give them the types of skills that they need to go through the interview process. We actually, I should have said this right away, we've donated all the royalties, and I'm sure they're huge, from our book to an organization called Rock the Street Wall Street, which actually starts at the high school level. And does DoubleLine have a partnership with Rock the Street Wall Street? I'm not sure.
I don't believe so. We have actually sponsored a couple of scholarships too at like Dartmouth and the local colleges here too for women in finance, in memory of one of our former PMs who passed away. She was a big advocate of women in finance too. Bonnie Baha, yes, correct. And so
she guest lectured for my class at Columbia. So
okay, yeah, she was a great woman. Yes, definitely.
She was.
Yeah.
So yes, Rock the Street Wall Street starts at the high school level and exposes high school girls to women in finance. And it's not just investment management. I mean, it can be everything from a financial advisor to a portfolio manager to an economist, and gives them, some really practical training in investing. So as opposed to what most people think of as financial literacy in high school, which tends to take, again, the form of like budgeting and checkbook balancing, which is great. Rock the Street Wall Street actually teaches young women about investing. So then at the college level, there are organizations like Girls Who Invest who help girls get internships at firms like DoubleLine, which then can lead into full-time career opportunities for them. And again, this is a matter of exposure. So widening the on-ramp to us just means exposing women to the career, debunking some of the common myths about the career, in particular this image issue and the work-life balance issue, where people think you have to work 100 hours a week if you're going to be a good investment analyst or portfolio manager. And showing them that there are other women who do the job and that there are lots of different models for that. In our Constellation chapter, we talk about the successful female analysts and portfolio managers who we interviewed. And we try to create a bunch of different prototypes so that people know that there's not just one way. One of the jokes when I started at Capital was that all the successful women at Capital, it wasn't really a joke, it was kind of true, had husbands who stayed home. So that can be very off-putting, right? If you think that this job requires you to find that unicorn husband who will stay home with your children, either that or be single. And in the book, we make sure that we show that there's a diaspora of women who are successful doing what we do, and lots of different family archetypes and structures. And then at the MBA level, when we talk about widening the on-ramp, we really challenge investment firms like DoubleLine to make sure that they are casting a wide and fair net in their recruiting practices. One of the stories that we hear over and over again is that in the recruiting process, there's a lot of lionization of actual investment experience. So I think this is actually like a true story. It's not an urban myth, but you've got the earnest young man who comes in and talks about the fact that when he was 7 years old, he asked his dad for a brokerage account because he wanted to buy Starbucks stock, because he had figured out a good thing, because his mom could not walk past a Starbucks without getting her triple grande skinny latte, whatever it is. There's so many assumptions in that, right? So you've got to have investable wealth. You've got to have parents who understand brokerage accounts. We'll go back to the question of whether the son had heard something different about investing, had been encouraged to invest the way that his sister perhaps had not. So there's a whole socioeconomic thing there. What we would challenge investment firms to do is to routinize the interview process and make sure that it's not unfairly advantaging a certain demographic of people who may have had access to this lingo of investing that other types of candidates did not.
So one of the things that I liked, it was actually in the synopsis as well, is just talking about some of these subtle barriers that I think we're discussing now. But there's also, up to this point, the discussion is largely focused on entering the field, promoting interest, developing that interest, perhaps widening that on-ramp, getting from either undergrad and MBA, but getting in the door is one thing, staying there, thinking about paths for career advancement. And if I recall correctly, that 10% or so in investment management pertains strictly, especially to portfolio management roles. So there's this, which I would say probably implies that there's either an attrition rate there or just certain individuals aren't making it to those decision-making roles. And that's an important part of any career, right? Especially people that seek out professions in investment management. They tend to be a little bit more of go-getters, alpha, and want that career, see that career investment. So if you can just talk a little bit about barriers there, subtle or not, the importance of really retaining and promoting within these organizations.
Yeah, alpha, no pun intended, right?
Yeah. Like you said, sometimes it's about not getting alpha too, right?
Yeah. And I know a lot of ways not to generate alpha.
Yeah.
So yeah, I mean, that's a great question. And I don't know if this is an actual term or not, but we use it in the book. We call these psychocultural barriers, which prevent women, once they're in the door of these investment management firms, from really evolving into the portfolio managers that they probably started out wanting to become. And there's no great analog for portfolio managers at other types of corporations, right? So in the book, we kind of liken it to the role of a partner at a law firm or at a big four, however many there are now, accounting firm or something like that. So we really sort of give portfolio managers the status of this management team, because they are the ones who the analysts really are feeding ideas to and are making the final decisions about the portfolio. So the data that we have says that 14% of investment analysts are female. This is data from the CFA. So already you're looking at a promotion issue with women versus men. Only 10% of portfolio managers are women. So that means that women are not being promoted, if you consider it a promotion, which many people do, from the role of analyst to portfolio manager. Why is that? We talk a lot in the book about the role of confidence in our industry. And it's really interesting. I saw an old friend who was a college roommate. She went to HBS, graduated the same year I graduated from Kellogg with her MBA. She ended up doing something completely different, but we were talking about investment management. And she said something I've never heard anybody say, but that we talk about in the book. She said, well, I took a finance course, and the minute that I heard that markets are efficient and that there's really no good way to beat them, I decided that that wasn't a career path for me. So definitionally, becoming a professional investor means putting a stake in the ground and saying with confidence, I can beat the market, even though I just paid $100,000 for my MBA that tells me I can't beat the market. Women are at a structural deficit when it comes to confidence. There's a great book called The Confidence Code. You don't even have to read the book. You can read the Atlantic article that the two authors wrote that distills the points of the book. But here they reference things like the classic HBS study that says that men will apply for a job if they think they've got 60% of the criteria versus women feeling like they have to have all of the criteria that are listed in the job description. That is, just one of many examples that the authors cite of the ways in which men excel in the area of confidence. This industry, to a fault, lionizes confidence. So I think about my early days at Capital. And by the way, I think Capital is an amazing investment firm. It's got, terrific numbers. It's one of the few firms that consistently outperforms the benchmark net of fees. However, even at Capital, there was this concept of the high conviction idea. So portfolio managers would tell analysts, we only want your high conviction ideas. If you go back to the efficient markets hypothesis, and of course, you can take issue with that, that says, you've got to give me all these great ideas that say that you're smarter than the market and you figured out a huge valuation discrepancy. And the thing is, 9 times out of 10, it's you probably haven't, right? So either the market is right, or you didn't do enough homework to realize some of the downside risk in what you were looking at. And again, I think this confidence barrier to women is one of the reasons that they have a hard time making that transition from analyst to portfolio manager. Because in addition to having to have confidence about your portfolio being able to beat the market, you also have to have confidence that you're good at a job that you haven't done yet. So unlike becoming a partner at a law firm, you're already a lawyer, right? You've got your law degree and you are jumping through the hoops that you need, the billable hours that you need to have to get to that partner level. In investment management, that promotion from analyst to portfolio manager is much more fuzzy. It's hard to say whether if you're a good analyst, you'll be a good portfolio manager. And for women, sometimes it's easier just to put our heads down and say, I know I'm good at my job. I know I'm good as an analyst. I don't want to take the risk of raising my hand and promoting myself into a new role that I don't know that I'll be as good at.
Yeah, I've heard that too before too. It's just having that difference in the confidence level. And, as we think about it from like a hiring perspective too, you get a lot of pushback from people who are trying to, achieve this diversity and say, well, what I'm really looking for is a meritocracy. It's the best candidate that comes through, right? And we know that's a big fallacy there. And or I don't see enough of candidates out there. So how am I supposed to hire someone? And, we've seen that at times too, that there's certain demographics that are probably underrepresented relative to the population on our staff, right? And we look at these kind of metrics and we ask ourselves, how do we find these candidates? So what do you recommend to people who are out there trying to, think about having a more diverse set of employees, right? Female, ethnicity, race, whatever that may be. And talk about some of the fallacies in thinking about this meritocracy component. And then further, how does one try to improve upon that?
So I'll start with the meritocracy component first, because that's the easiest thing. So the big fallacy, sort of the overarching theme of our book, my aha moment was, in an industry that claims to be a meritocracy, how is it that we have failed to deliver returns in excess of a benchmark net of fees, right? So the whole meritocracy thing at an industry level, and I'm not talking about DoubleLine, and I'm not talking about my firm or capital, we're all like woebegone, better than average. But the bottom line is we know that active management has not delivered what it said it was going to do.
So I just love the Lake Woebegone reference. I have to always just point that out. So many people use that. I love it. So anyway, sorry.
Me too. My dad was a big PHC fan. So if you take that on the one hand, and then you say, well, this industry is a meritocracy. So, it just is what it is, right? Like people come and they do well and they beat their benchmark and that's how they get compensated. Well, we sort of know that that's definitionally false. That goes back to something Sam asked about, which was this concept of the subtle psychocultural barriers. And one of the conclusions that we had in writing the book was our enemy, or the barrier to change in our book, is not really these kind of Me Too, Harvey Weinstein types of people. We talk about the fact that we may manage money for the Harvey Weinsteins of the world, but we don't work with them generally. So the bigger challenge is exactly what you said, Jeff, which is that many people operating within the industry say, well, I don't see color, I don't see gender, I only see numbers. And the problem is that we know, A, that that's not true, because lots of people get bonuses even when they didn't outperform their benchmark or other, because there's other sources of compensation. And B, if it were true, I believe that the industry would be more diverse, right? Just because more diverse perspectives should lead to better investment results. Now, as it pertains to the question about how to cast that wider net, I don't feel like we have a lot of great answers for that. I think it goes back to giving, we only talk about women in the book because we are both white. So we certainly have no business talking about any of the other categories of people who are chronically underrepresented in our industry, although we feel that some of the themes are similar. But making sure that underrepresented demographics have exposure to the industry, to the career path, that we debunk some of those myths early on. So it's not, you don't have to be a quant genius. 8th grade algebra usually will do for a lot of the research that you can bring
Don't
to
tell
bear.
anybody. The secret is that we know algebra. Everybody thinks it's complex stochastic calculus. It is algebra, but don't tell anybody, okay?
Algebra.
Yeah.
It is. So once you start to tell people, to let that cat out of the bag and really to introduce people at younger ages to the career path, I think that increases the pool of people who are interested in pursuing the career. And then that has the knock-on effect of, building out the pipeline. So that's what people always talk about, right? Well, we would hire women or minorities if we could, but there's no pipeline. So we have to start building the pipeline. However, before that, we also, or in tandem with that, we talk about this flywheel of the investment management business. We have to make sure that we are adding and keeping women at the mid and senior levels of management at investment management firms. Because guess what? Those early people in the pipeline are going to want to see them. They're going to want to talk to them. They're going to want to see them. They're going to, sorry, I'm just going to say her name. They're going to want to see someone other than Kathy Wood talked about in the press, right? Because if you were a woman considering this career path and all you read about as a role model was, someone who is very high profile in that way and who gets a lot of really negative press, I think that could be very off-putting, right? So we need more women who appear regularly in the financial press. My co-author, Katrina Dudley, does a great job. She's on Bloomberg constantly, just talking about the markets. Having those types of role models helps steer younger women towards the career path. Then at the actual investment management firms, that's where we get back to the 3 Ps. Analyze your data. One of the fascinating things about promotion, I think we put this in the promotion category, but it sort of straddles pay as well. There's data that says that, and you probably know this from your personal experience, the industry coverage given to analysts is skewed by gender. I am a case in point. What my first industry was? It was retail. There's a lot more women who cover the retail sector than there are who cover the technology sector, which tends to be very, very male dominated. Now, if you look at the performance of these from a stock perspective, you can guess which one has outperformed over the last, gajillion years. If you are a manager at an investment firm thinking about who to promote to portfolio manager, even if you've got benchmark adjusted indices that you're comparing analysts against, the human nature reality of it is you'll see that the male analyst has had these great calls with the FANG stocks, whereas the female analyst, all she's done is keep you out of JCPenney and Macy's when it's going down and all these other crappy retail stocks that nobody wanted to own anyway. And nobody ever gives you credit for keeping people out of things or for serving the portfolio manager, the Brussels sprouts of the utility sector, which nobody really wants to talk about, but probably belong in everyone's stock portfolio. So getting clear about those types of differentials that have nothing to do with the person, but have everything to do with, the industry can really help make sure that women stay and are promoted at the same rate as men.
So with that, I have to jump on. First of all, I've never heard anyone call the utilities the Brussels sprouts. I love that, first of all. And by the way, I like Brussels sprouts. So
Me too.
But you mentioned the alpha component, and avoiding things is an alpha generation process, right? Especially as a bond investor. I mean, a lot of it is avoiding some of those blowups too. But I want to jump on one last thing about all these gender roles that we were talking about. And because I really want to get into markets a little bit too, to show that, you do have all this expertise in high yield market. I want to jump into that a little bit. But how, in the book you talk about, there's a bunch of organizations and resources out there that can be helpful to women. There are in the industry looking for this promotion or trying to get into there. Are there any favorites you can point out to our listeners so they can go do some research on this and potentially help support some of these organizations as well?
Yeah. So again, I think the 2 that I would really highlight are Rock the Street, Wall Street, which for any of your listeners who work in finance, not just in investment management, but any sort of tangential role in finance, go find a local Rock the Street, Wall Street affiliate. They're in, I believe, 20 to 25 cities at this point, and volunteer. All you have to do is walk into the classroom. They have a ready, pre-made curriculum. It is just great for young women to get exposed to these types of careers at a very early age. Girls Who Invest, I'm not actually sure if they have volunteer opportunities or not. You can certainly donate to it. It's a nonprofit. But then for any of the, if there are any more senior women watching this, my call to arms is please go out and talk whenever you're invited to talk. So make sure that the media is seeing examples of women, is covering our industry fairly. Make sure that you applaud great coverage of our industry as opposed to articles like there was one in the Financial Times, and I love the Financial Times, not just because occasionally they publish the stuff that I write. It's a great newspaper. However, they had an actual headline that said, "Hedge fund bros gonna bro." This was a couple of years ago. So does that make you as a young woman really want to get into the industry? No. And there's a whole lot of ink spilled about some of the bad actors in our industry. So every 5 minutes, there's an article about someone named Crispin Odie. I don't even really know who he is, but he sounds like a really, really unpleasant coworker. So my challenge to people is to make sure that you're reading media that is fair and broad in its coverage of the types of people who work in our industry, and that you do a little digging to make sure that you're not just reading the ones that come to the surface who may make for great clickbait, but are not representative of the types of people, I'd like to say, like us.
No, I think that's great out there. We really wanted to promote some of this today, as well as your book too. So before I jump into the market, remember Sam held it up earlier, but for those of you listening to the podcast, it's called Undiversified: The Big Gender Short in Investment Management. And as you said, the proceeds, all the profits are being donated as well. So this is not some try to get rich quick scheme. Although I'm sure you're selling lots of copies out there, you're trying to actually help promote the cause by educating folks on this. So before we transition to Sam's favorite part of the show, I've got to ask you about the credit markets today. And here we sit here on March 15th. We have a Fed meeting tomorrow. I hear from a lot of punditry and insiders from the Federal Reserve where they say that Jay Powell is someone who studies the credit markets. And I haven't really seen that a lot, where he's worried about liquidity, everything. And so we know that rates have been going up in anticipation of the Fed hiking this year. How are you thinking about that bleeding into the high yield market, the sector you cover, or the segment of the bond market you cover? And what are your thoughts about this path of interest rates, the unwinding of QE, or the unwinding of the balance sheet a little bit, doing in a quantitative tightening as well? And are you concerned about the ripple effects that potentially QT can have on the high yield market? So not a lot in that question, to unpack. So yeah, so feel free to jump in wherever you like on that, because I really want to pick your brain on this.
Yeah, so I want to. This is a little bit off topic, but this has been turning in my head ever since somebody asked me the question in one of my Columbia classes in January. We were talking about all the stimulus that came into the market in early 2020. I'm going to go back a couple of years, even though most of the time we don't have memories in this market. And one of my students raised her hand and said, "Why do you think there wasn't as much of an uproar from the American people about what effectively were bailouts of, among other things, high yield investors, right? By all these novel types of stimulus, as there was back when the banks got bailed out, and it stumped me. I did not have a good answer for that. So that sort of sets the stage for
because Jay Powell used to traffic in that market. He's got friends. Is that what you're saying?
I don't know. I think it's because nobody knew, right? So our industry, and this goes back to some of the things we talked about, is so opaque to the general public that they don't know that a lot of that check writing went directly into, the hands of high yield bond investors who sort of got bailed out of some bad investments. Now, talking about the high yield market specifically, one of the interesting things that's happened year to date has been that if you look at excess returns in our market versus the investment grade corporate market, we're actually holding up pretty well. And in fact, triple C's have been the best performing of the ratings categories in the high yield universe. Now, part of that is duration, right? So triple C's have the shortest duration of any of the ratings categories. However, what that says to me is we have not seen anything like a traditional risk off market. And that makes me, even more comfortable being conservatively positioned, which is just my sort of natural positioning as an investor. There's some really great things that have happened in the structure of the high yield market since the pandemic. So first of all, we had all these fallen angels come into our market. A fallen angel is a company who gets downgraded from investment grade to high yield. So companies like Ford and Macy's, and I can't even say it without wincing, Oxy, Petroleum. These companies all came into our market, and through the magic of the Fed and what effectively became bailouts of these fallen angels, because so much life was breathed into risk appetites, these companies are all basically marching back to investment grade. However, there's still parts of our market, and they still make up a very healthy component of the high yield market. The other thing that happened at the early stage of the pandemic was that it pulled forward a lot of bankruptcies that were just kind of hanging out there, stumbling along, waiting to happen. Great examples of these: Chesapeake, JCPenney, Neiman Marcus. So a lot of companies got torched, crystallized their value, unfortunately, at a very bad point, but left our market. And that washout made the high yield market a healthier place with a healthier constituency of companies. If you look at the ratings composition of our market today, it's higher than it's ever been. Now, of course, the problem, among other things, is that ratings are backward looking. But if you just took ratings at their face value, it would say that given the proportion of double Bs in our market, it's a very good place to be relative to history. And by the way, that's really different from investment grade corporates, right? Where triple Bs, I think, are still hovering at close to the highest component of the market that they've ever been. When you play it out, though, I'm not even sure it matters that much. I don't think that anybody knows what's going to happen when the excessive liquidity leaves the system. We know that it will cause risk appetite to go down. I don't personally know. It's above my pay grade, Jeff, to say how that's going to affect high yield, other than to say that I think the classic positioning strategy, if you're concerned about valuations, makes sense today. Stay higher in the capital structure, own secured versus unsecured paper, stay shorter duration, just all the typical thematics that you would think about when you are positioning yourself for another leg down, which is my personal investment thesis. And we haven't even talked about a recession yet, right? So all the indicators are gathering steam towards recession, even just one triggered solely by oil prices. We've seen that before. I was really young, but we have seen it.
Yeah, well, the good news is oil's retreated a fair amount. We're really almost back to like pre-invasion levels in oil prices today. I have one more question then too. So I really like the way you distill it down by focusing on triple Cs, because people say, oh, high yield soft, everything's in trouble. But this doesn't look like it's a significant increase in risk premium due to defaults or this recession at this point. Yes, the yield curve is kind of indicating, that the recession probability is increasing. We all know that. The Fed is going to hike significantly this year, is likely. But when we look inside of the credit, I hear this from our credit teams. I hear it from Monica on the IG side. The quality is good, and so it's a function of more rates and a repricing of just the price of money more than anything else. And so you brought up the R word. I'm seeing a lot more of articles focused on that. How are you thinking about a recession? I know how you position your portfolio, but how are you thinking about this stage in the cycle? And, do you think that the Fed can actually engineer the soft landing?
I can't answer the second part of the question. Don't know. Hard to say. In terms of a recession, the standard philosophy would be to make sure that you reposition into defensive sectors. So this would be like hospitals, healthcare, huge and high yield. What's interesting is that during the pandemic, we found that those weren't exactly as defensive as we thought, right? Because when you cut off elective surgeries, they basically are bleeding cash. But leaving that aside, they made it through the pandemic. So that would be the standard playbook here. And I don't think there's a lot different this time. I think one of the really interesting structural changes that happened, if you look at a company like Macy's, which I've followed since, before the May Federated merger, when it used to be called Federated. So that was a long time ago. And it has not only survived the pandemic, despite the fact that all of its stores were closed for some period of time, and there was a real diminution in consumer interest in their higher margin items like suits and, workplace apparel. It has come through it a stronger company because the pandemic forced Macy's to get really sharp on their digital strategies. Not that they didn't have a digital strategy before, they did, and it was very good. But all of a sudden they went from being a brick and mortar company with, a tiny little digital component to almost a 50-50 blend. It's not 50-50, but it's getting there. And I think that there's a lot of other companies that managed to reinvent themselves by by default, no pun intended, during the pandemic, that are actually in a better position with respect to their cost structures as we enter into what could look like, a nasty recession or even a mild recession than you would have thought even before the pandemic. So I guess what I'm saying is the cost cutting, especially in the high yield market, because these are companies that didn't have a lot of, fat to cut to begin with, but how much they managed to whittle down their cost structures in response to the pandemic, they're in a really great place, I think, to operate through a recession relative to what you would have said maybe 3 years ago.
Okay, yeah, no, I think that makes a lot of sense too, and there is really a lot to really focus on there. But unfortunately, Ellen, we're running out of time, and so the thing about this is that we have a time limit, and Sam has a favorite part of the show, and so we've got to get to Sam's favorite part of the show because he's holding up the book again, and we want to give one more plug for the book, Undiversified, right? The big gender short in investment management. So Sam, why don't you introduce Ellen to your favorite part of the show?
It's my favorite part of the show.
Scared.
Yeah, it's my favorite part of the show because I'm rarely the recipient on the receiving end of this. But it's called Sherman Says. It's where I will offer a series of alternating prompts between you and Jeff. Each one will be unique, to which I hope to get a top of mind, somewhat concise answer. And I'll start out with Sherman first to give you an example with soft landing.
Infinitesimal probability.
All right, this one is for you, Ellen. Kill all your darlings.
Oh, Faulkner. Or was it Hemingway? I don't know. Yes.
Faulkner, yeah. Oh, yeah, I guess it could be Hemingway, though, too, right? And known for his being concise, to the point, and keeping it real. Or not keeping it real, but straight to the point.
Yeah.
Yeah, unlike your response there, you should have said concise, but you kept lingering.
I kept going, right? I kept going, but there's a piece in the book where it was perfect. It was perfect. So back to Sherman. Fed independence.
Exist.
All right. Back to Ellen with safe haven asset for 2022.
Treasury bonds.
Globalization.
Long bonds, right?
Well, I think we've overpriced in some cases, but yeah.
Sorry.
Back to you, Sharon, with globalization.
It's trending away from.
All right. Stagflation.
Maybe.
Nickel.
I hate nickel right now. It's been a thorn in our side. Let's trade in America. I don't like the London Metals Exchange. CME, if you're listening to this podcast, start listing nickel contracts, limit them up and down, and don't close the market for 6 days. Do I sound frustrated? Because I am, yes. It's opening tomorrow, though. It's back in action. So everybody get up at 8 a.m. London time to watch the 5 minutes of ring trading tomorrow to see if we can figure this out.
Yeah. So
if you want to know more about nickel, listen to Sam's other podcast where they complained about it last Friday with him and Jeff Mayberry.
Yeah, we try to keep it low key.
Yeah.
But the next one for you, Ellen, was Brovest, but you already brought that up. So let me think of a new one here. Heels, flats, sneakers. All of the above, or do you have a favorite for this?
Oh, come on. I live in Asheville, North Carolina. Sneakers, and when I get super fancy, boots.
All right.
Nice.
And then let's see, back to Sherman with favorite wine.
Chateau Margaux. Love the region. Stay away from the Bordeaux's, but the Margaux. Doesn't have to be the Chateau Margaux, but that region is on the list these days.
All right. And then to wrap it all up, Ellen, with craft beer.
So many. Highland Brewing. It's one of our local breweries. We have a lot. Y'all should come visit.
All right.
Yeah.
That one was to Mr. Mayberry.
Yeah. We actually went to Mr. Mayberry's wedding there, is one of the other podcasts he does. So they had it there. So we did do some tours around there. I don't remember all of them. He's going to kill me for not remembering them. But it was a beautiful place. And I see why you want to live there.
Yeah.
Yeah.
If I had gotten wine, by the way, my answer would have, or favorite wine, my answer would have been beer.
So I know there's a champagne of beers, but is there a wine of beers? Yeah. Okay.
Just beer.
All right. Yeah. So Ellen, where can people get access to the information? They can get content from you. Obviously, the book's available out there. We got it from Amazon, but where can people get access to Ellen Carr?
I'm only on LinkedIn. I'm basically in the Stone Ages when it comes to social media, but find me on LinkedIn.
Okay. Well, you can hammer in that tablet, etch it out, and send her a message. So, Ellen, we really enjoy it. Thank you for joining us today, and thank you for putting a book like this and just educating people, and just the cause you're doing here, just to get the underrepresented represented, I think is a very important cause. And so we can all do more. We can all be better. And so I appreciate you spending time with us today.
Thank you for having me. It was great meeting both of you.
All right, everyone. Thanks for joining us for the latest episode of the Sherman Show. We have another one coming soon. You can find all of these Sherman shows on our YouTube channel. It's youtube.com/DoubleLine Capital. That's DoubleLine Capital, all one word. You can also find us on the Twitter. The Twitter handle is @ShermanShowPod. And you can also catch these on SoundCloud, iTunes, Google Play, Google Podcasts, some other podcast app. You can even go to the website, doubleline.com, and find our podcast on there as well. And also, thanks everybody for welcoming Sam back to the podcast. All of your responses really encourage him to come back, and the fandom he really has here. So thanks again, and tune in soon to the next episode.